Welcome to this explainer. Look, forget the stock market for just a second. If you really want to understand the invisible hand that actually drives the global economy, we have to talk about the massive debt and currency markets. Equities get all the flashy mainstream headlines for sure, but understanding fixed income and foreign exchange is absolutely crucial. They dictate the movement of literally everything else, including stocks and futures. So let's jump right in and decode how these macro markets actually function.
Trillions. That's the scale we're talking about here. Imagine trillions of dollars changing hands every single day. While equities give you a tiny piece of ownership in a single company, fixed income lets entire governments and massive corporations borrow capital, and foreign exchange allows the global trade of national currencies. The problem? Most retail traders completely ignore these massive markets, which leaves them flying blind to the broader economic environment. But by tracking the trillions flowing through bonds and Forex, you essentially get a crystal ball to anticipate massive shifts in other asset classes before they even happen.
So what exactly is a bond? The core premise is pretty simple. Think of them as government and corporate IOUs. When massive entities need to fund huge infrastructure projects or operations, they don't just swipe a credit card, right? They issue bonds. It's essentially a loan you make to a borrower, and in return, they agree to pay a set rate of interest over a specific period, plus your original money back. Because this setup gives you a highly predictable stream of income, it acts as the absolute cornerstone for capital preservation strategies, helping you bypass the crazy volatility of stocks.
To actually use these instruments, you have to know how they're built. Every single fixed income security boils down to three primary elements. First, you have the face value, or par value, which is the exact amount they'll pay back at the end. Second, the coupon rate, which is just your annual interest. And third, the maturity date, the exact point when the debt is fully repaid. By mechanically tracking these three components, you can actually calculate your exact expected return from day one, assuming the borrower doesn't go bust, of course.
But here is where it gets a little tricky, and it's a massive pitfall for new bondholders. It's the seesaw effect between price and yield. When interest rates in the broader economy go up, suddenly newly issued bonds offer higher coupon rates. That makes older bonds with lower rates look terrible, instantly dropping their market price. Conversely, when rates fall, those older, higher-paying bonds become incredibly valuable, driving their prices way up. The key takeaway you need to remember is this: yield moves in the exact opposite direction of price. Grasping this dynamic is everything. Let's break down how this applies to the different types of debt out there. It's all categorized by the issuer, and each one carries a different level of credit risk. At the top, you've got U.S. Treasuries. Backed by the U.S. government, these are the risk-free benchmark for the entire global financial world. Then there's corporate debt, which pays higher interest to compensate you for the higher risk of a business going under. Finally, municipal bonds from local governments, which can offer some really nice tax advantages. Ultimately, your strategy here hinges entirely on your mechanical risk management and appetite for credit risk. Real quick, before we dive headfirst into the absolutely chaotic world of global currencies, a huge thank you to our sponsor. If you want to track these macro capital flows with absolute mechanical precision, you need the right tools. Save $15 using our referral link in the description to get the standard in charting with TradingView. It's hands down the ultimate tool for retail traders to visually analyze these complex market shifts. Okay, let's pivot and ask a critical question. What market literally never sleeps? The answer is Forex. Unlike the stock market with its very rigid opening and closing bells on Wall Street, Forex is a decentralized, over-the-counter beast. It operates 24 hours a day, 5 days a week. The action just flows continuously, starting in London and New York, rolling right into Tokyo and Sydney. Because it handles international trade, tourism, and massive global speculation, it's the most liquid market in existence, pushing over $7 trillion a day. So how do we actually trade this thing? Well, currencies are never traded in a vacuum. It's always a constant tug of war between pairs. Every single transaction is simultaneously buying one currency and selling another. Step 1, identify the base currency, which is the first one listed. Step 2, identify the quote currency, listed second. Take Euro USD, for example. The euro is the base, the US dollar is the quote. If the price is 1.10, that strictly means 1 euro costs 1.10 US dollars. If your data says the euro is getting stronger against the dollar, your move is simply to go long on that specific pair. Now, don't make the mistake of treating all pairs equally. They are classified based entirely on liquidity and the size of the underlying economies. Major pairs, like Euro USD, always include the US dollar. They have the absolute highest volume and lowest transaction costs. Minor pairs involve major global economies, but completely skip the US dollar, like Euro GBP. And then you have exotic pairs, like the USD paired with the Turkish lira, involving developing economies. Be super careful with exotics. They are way less liquid, meaning you are going to pay for it in brutal, wider bid-ask spreads.
Before you even think about entering a trade, we need to talk about mechanical risk management. You have to know how to measure price movement first. Enter the pip, or percentage in point. For most currency pairs, a pip is just the fourth decimal place. If the ER/USD moves from 1.1050 to 1.1051, that microscopic fraction is 1 pip. The only major exception is pairs with the Japanese yen, where it's the second decimal place. But here's the thing. On their own, a 1 pip movement in a standard cash account is basically just loose change. To make those tiny pips actually matter, traders use leverage. And here is the core problem. Leverage is the ultimate double-edged sword. Sure, it lets you control a massive position with a tiny amount of capital, beautifully amplifying your gains. But without a mechanical system, it's a one-way ticket to blowing up your account. Leverage amplifies gains and rapid capital loss. If the market turns against you and you are over-leveraged, it will destroy your capital faster than you can blink.
So what's the actionable solution here? Position sizing is fundamental for risk management. Disciplined scaling rules are absolutely not optional. You have to strictly and mechanically calculate the exact financial value of a single pip relative to your specific contract size before you ever click buy. If you don't know the exact dollar cost of a 10-pip drawdown, you aren't trading, you're just gambling. The key takeaway? Mechanical contract sizing is the non-negotiable requirement for surviving the Forex market.
Okay, we know the mechanics, and we know how to strictly measure our contract sizing and risk. But what actually drives these massive capital flows? Trillions of dollars don't just move around by accident. Because bonds and currencies are directly tied to the credit and value of a sovereign nation, they react violently to the fundamental weather of the global economy. Let's look at the primary catalysts that actually force these institutions to move their money. The absolute biggest driver of currency value is the interest rate set by a country's central bank. Capital is greedy, plain and simple. It constantly hunts for the highest yield. Investors naturally gravitate toward currencies and bonds offering higher rates. This creates the famous carry trade dynamic. Traders mechanically sell currencies with lower interest rates to buy currencies with higher rates. When a central bank signals a rate hike, that currency appreciates immediately, which simultaneously dictates bond prices. It proves just how deeply connected global debt and currency really are. Central banks don't just guess on rates, though. They react to hard economic data. The Consumer Price Index measures inflation, and non-farm payrolls tracks employment. High inflation usually forces higher interest rates, which strengthens a currency but absolutely crushes existing bond prices. And don't forget geopolitical risk. Elections, trade disputes, sudden instability, these consistently trigger violent market fluctuations and massive flights to safe haven debt. Tracking the economic calendar isn't a suggestion, it's a mandatory part of your strategy.
It's also vital to recognize exactly who you're sharing this market with. Forex and fixed income are completely dominated by institutional whales. Central banks are in there managing national money supplies. Commercial banks are facilitating multi-billion-dollar exchanges for corporate clients, and hedge funds are constantly hedging risk or aggressively speculating. Never forget who you are swimming with. As a retail trader, you're a minnow. But here's the good news. That sheer institutional volume is exactly what provides the deep liquidity, allowing you to execute trades instantly.
Understanding how these two macro markets function gives you the essential context to see why the stock market might be moving the way it is. Money doesn't disappear, it just rotates. Capital flows constantly search for the best risk-adjusted return between these asset classes. Fixed income acts as your defensive component, while Forex provides hyper-liquidity to profit from global shifts. Tracking this constant rotation between defensive bonds and liquid currencies is literally your roadmap to predicting the broader financial weather. Which leaves us with a final provocative thought. Are you just trading in the dark, hoping for the best? Or are you actually tracking the macro liquidity that moves the world? Mastering this global puzzle requires mechanical discipline, perfect contract sizing, and highly actionable scaling rules. To lock in those solutions and build a resilient framework, grab your copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. Get the mechanics down, respect the risk, and let the macro flows work for you. Thanks for joining this explainer.